We have Aashish Somaiyaa who's joining us now to talk more about markets from White Oak AMC. Aashish, afternoon. Thank you so much for your time. A good day to be having this conversation. I'll ask you a question on behalf of a lot of our viewers who are just looking at the screen. How should one approach this kind of a market? Massive gap up, and it's not allowing anybody, or you see that one should look at the market on a 3 to 5 year kind of a horizon now and start getting positioning in, because the risk would be not to be adequately positioned in this market.
Yes, Ajay, thanks for having me. And I would actually say that you summarized it perfectly, my thoughts exactly. If you really ask me and a lot of people that I interact with, frankly, because if you see 45 days back, say 30 to 45 days back, there were 3 or 4 things to watch out for. One clearly was India's political season. But apart from India's political season, clearly last 2.5 years of interest rate hikes, strength in the dollar, weakness in emerging markets, I think that is something also which was something to watch out for. And then the geopolitics, of course, had taken its own course. Now, compared to where we were a few days back, back to back, what has happened is that the US 10-year bond has rallied quite sharply. The dollar index has come off. And usually this is a forewarner of flows into emerging markets. And within emerging markets, we know reasons why India stands to benefit maybe disproportionately. The weightage of India in the indices have also gone up. So any turnaround in sentiment towards emerging markets, which normally gets accompanied with dollar depreciating and, the change in direction of flows. So that is one thing which has changed in the last few days. And we can clearly see that, what works in the markets and the texture of the market is also kind of rotating. The second thing, of course, is geopolitics. It seems like there are no escalations. And then third, one would ideally wait for April and May to see the general election. But I think, I think going by a commonly used phrase, something like semi-final, it seems like there is a strong wave in favor of the ruling party, and markets love continuity. So, long story short, I think most investors, whether they're domestic or global, they would finally realize that the event risk has come down, and rather than staggering or delaying or waiting for the main event, it's better that exposures are built up and jump in right now rather than postponing investing.
Aashish, I want to understand from you how do market actually factors elections in a way that yesterday, if you saw the victory speech of Prime Minister Modi, he was exuberating a lot of confidence that this is a kind of a sign of what is coming in 2024, and I mean, he even called it Modi ki guarantee 2024. But market would read all of that in, right? So going into the election, as it is before the state election, also the probability market was assigning for national election BJP continuity was high. Now it got even more stronger. So next 4-5 months, the trajectory of the market, I want to understand. Also that it will be coinciding with rate cuts, right? Mid or next year is where now we are talking about rate cuts. So how does this combination look, and how would market start factoring this in?
Look, the reality is that, we have to respect the market, because whatever you and me may discuss, the fact is that there are millions of wise participants, and that's how a market gets made. And the sum total beliefs, the sum total expectations of these millions of participants is exactly what the market actually does. So given that today there is a significant gap up, and given that today, say for example, Bank Nifty is up by nearly 2.5 to 3%, given what we are observing in the market, it stands to reason that the market is positively surprised. And let's say if there was a fraction of probability that we may not get continuity after May, that fraction has come down and become even smaller compared to what it would have been. See, there is nothing is impossible. We all know nothing is impossible. But if there was, say, a small fraction of a chance that we would not get political continuity, compared to that fraction has come down and become a minuscule fraction going by the data. Second thing, like I said, that apart from our political season, the bigger thing to watch for was the US interest rates and the dollar, because if US interest rates were held high or if they were raised further, then the dollar would remain strong and emerging markets like us would not attract, irrespective of our domestic scenario, we would not end up in attracting flows. People do a lot of analysis, fundamental analysis of the performance of these big banks, but if FIIs are sellers for 2 to 3 years, then big banks would not move, right? Because that's a severe headwind. Selling is a severe headwind for them. So I think a lot of those things have changed. And I would put it this way on your question that we are now running the risk of front loading next couple of years of returns. That is the thing to really watch out for.
That is important, very important point. That if a lot of good return get bunched in the short period of time, then you'll have to kind of give up future returns. I want to understand, what are your thoughts on the PSU trade or the PSU rally which we are seeing, and markets view that PSUs will be the vehicle of reform further, and this current government's focus on extracting more efficiencies. So that is where the money will be made. What are your thoughts there?
So obviously we would approach it company by company, sector by sector, because fundamentally speaking, a public sector enterprise is a serious generalization, if you look at it. And in the past, what one has seen is that, while public sector enterprises was not necessarily a focus of reform or not necessarily a vehicle of economic delivery, yes, with this disposition, with this government, the attitude seems to have changed. Previously, it was all about investing and encashing, and now I think they are becoming purveyors of economic activity rather than just being cash cows. So clearly, from that perspective, the outlook would kind of change. But still, one will have to look at it stock by stock and sector by sector, and I don't think one should really generalize. That is one thing. Second thing, let's keep in mind that PSUs as a generalized category has run up quite a bit in the last couple of years, within certain sectors even more so. I have also noticed in past that when when domestic flow versus foreign flow, correct, what seems to work and what preferences investors have, there tends to be a difference. So if the nature of flow changes, loosely put, if the color of money changes, then what works might also rotate. So I don't think this is a time to just extrapolate what has happened in the last 1.5 years. I think one has to pick and choose. In terms of attractiveness, the big banks, the big banks seem to be the most attractively positioned. And then, consumer discretionary, if one looks at relative valuations. And then, of course, industrials and capital goods. While they have run up quite a bit, the fact is that, this government has been driving investments in a big way. So I would put it this way, that industrials and capital goods one has to look at. Now, in some of these places, you could end up buying PSUs or you could end up buying private sector enterprises. The fundamentals will come first.
Aashish, you travel and interact with investors across the country. What are your thoughts on flows? Do they look strong, at least from the domestic investors across?
Yes, I have no hesitance in saying that. In fact, I would also say, and today's market does reflect that, and our interactions do reflect that. I would say that there were people on the sidelines because say in March 2023 we saw 16,600. Now in hindsight that would have looked like a mouth-watering level, but it's not like we saw huge money coming in really. The fund flows in the industry have kind of picked up only after, say, September, October. We are seeing newer and newer highs and bigger numbers. And still, I would say that there have been people who have been waiting on the sidelines, thinking that, and rightly so, we should never judge what people thought after an event happens, because before that event, at that point in time, that was the reality. Today is today's reality. So because of all the uncertainties that we just discussed at the onset of our conversation, because of those uncertainties, people were actually on the sidelines. And we ourselves, including me, I used to tell everybody that, there are many events on the horizon. One has to drip money slowly and steadily over a 6-month period. But now it's that back-to-back 2 or 3 of these concerns have got sorted out. So then from that perspective, people have to change their thought process and they have to front load the investment. So I think a lot of people have been on the sidelines, and I think a lot of that money would come in the next few years.
Right. All right, Ashish, we'll let you go on that one. Thank you so much for joining us on the show.